if you focus on the results of the micro, you are never going to get the macro. But if you focus on the actions of the macro becomes inevitable. All right, let's talk about the dark side, spooky, of trading and what the gurus all over the internet do not tell you. So if we take a look at the screen right here in this document, here's a trade that I started doing in kind of like the middle of 2024. And let's just kind of review these numbers, because this is what a lot of traders actually see from gurus, course creators, all that stuff on the internet. If you take a look at this trade right here, so what you don't see on the screen is this started with a $100,000 portfolio, and the individual risk per trade of this particular methodology was 2.5% of the portfolio. So on the first trade from the whole entire study on the $100,000 portfolio, for example, well, the first trade risked $2,500. And then as the portfolio grows, as you can see here, there was a 65.56% return on the portfolio in 2023, and in 2024 is 59.8%. And this is a trade that is actually done daily. It's the same trade in the same stock done at the same time every single day. So if we take a look at some of these numbers with a $100,000 starting balance, this is obviously a really good result. We have 165,000 was the net profit, and things like slippage and commissions are factored in here. The compounded average growth rate is over 62%. The max drawdown is only 12%, so the return to drawdown ratio is 5.2%. It does win a little bit less than half of the time, but because the average win is almost double the average loss, and the maximum winner is like 4 or 5 times bigger than the average loss, it comes out to about $395 of profit per trade. Again, assuming, let me look, $1.07 commissions opening and closing, and 10 cents worth of slippage on opening and closing. And again, this is a trade that's done at the same time in the same stock every single day, kind of like rain or shine. So what most of the gurus out there, the course providers, the content creators, what they'll show you is this, right? And I've certainly done this in the past too. But what they show you is this. So when you look at this, you're like, holy shit, give it to me. Give it to me. And here's the challenge though. If you give this methodology, the same trade in the same stock at the same time every single day, if you give this to 10 traders and they all have the same starting balance and they're all given the same rules and they're all given the same information, they are, at least in my opinion, very likely, quite likely to get different results. Now, why is that going to be the case? Because a trade that wins a little bit less than 50% of the time is not necessarily something that people are going to like. And what you're going to notice here when I go down to the second image is the length of time between positive results, even on something that wins a little bit less than 50% of the time. Again, the average winner is almost double the average loser. But what they don't tell you is how this type of result, $395 per contract, is not always so linear. Now, there are strategies out there in the ether, in the world, that are a little bit more linear than this. Now, they probably don't get the same type of positive performance as something like this, but this is a volatility expansion method. Thus, we have something that wins a little bit less than 50% of the time. Thus, there are going to be periods in time where this is sideways to potentially lower. So what you're seeing on the screen right here, from January 1st, 2023 to January 1st, 2025, this is what the results of that strategy would have been. And again, I really didn't start doing this until the middle of 2024. So this is like not results I've gotten myself. You'll see here in a second what the results look like in the second half of 2024. That does line with what I was able to get myself. So again, this is the good, and this is what you normally see. And again, this is a trade that doesn't have that ultra high 80, 90% win rate, but it does have really positive numbers, a positive expectancy per trade. There's clearly some sort of mathematical edge here. The problem is this: to get those results, there were, at least in the study, many periods of time of sideways action, right? So if we look at this range right here, it was 3 months where this type of trade that ended with this performance after a 2-year study went completely sideways. And then we rallied a bit. And then there was a 2-month period almost immediately after that where the performance of the strategy went sideways to lower. Then it rallied for a while. Then there was a 4-month period where this particular strategy basically went sideways. And then after 1 or 2 days of this performing quite well, there was another 4-month period. There was another 4-month period where this did not work out very well. Now, there should be another vertical line right here. But from this period over to this vertical line, there's another 3-month period where it did not work very well. And then really since the beginning of September to almost the middle of December, August to December of 2024, that's like 4.5 months where the actual strategy that over the 2 years gave these results went absolutely nowhere. Now, again, this is what you will see when you hear about these strategies and methods. This is what you will not see. Now, the truth is this. If we take 3 months, 5 months, 9 months, 13 months, 16 months, more than half of the time, a strategy that ended the 2-year period with these results went sideways to lower. Right? I'm going to repeat that again. A strategy that over a 2-year period that ended up with these results went sideways to lower. And again, this is a little bit of an extreme example because volatility expansion trades that really don't have those ultra high win rates, again, this wins less than 50% of the time, they are certainly more susceptible to having these longer periods of time where the results of the strategy either go sideways or even sideways to lower, kind of like this period right here, like this period right here, like this period right here. So this is an extreme. There are a lot of strategies out there that have a smoother equity curve, but this is to prove the point. If you're looking for, let me see these results, 65.56% in 2023 and 59.8% in 2024. If you're really looking for those kind of high results, well, in exchange for that, it is potentially not going to be something that works every single day, every single week, and in many cases, every single month. But here's the deal. The question is this. Looking at this chart, a lot of people watching this video are going to say, ooh, I don't know. Would I really stick with it? Would I really stick with it for a 4-month period where the performance of the strategy goes 0? Would I really stick with it for a 2-month period where the results of the strategy are basically 0? Would I wait another 3 months right here? Or maybe 4? This is probably not 4.5 months. It's probably closer to 3.5 or 4 months, but whatever. Would I really stick through it? Would I really stick through it in those periods of time when I know this is kind of what the end result looks like? So again, when you look at this and then all of a sudden this happens to you, you may question to yourself, hey, is this strategy really what they said it was going to be? Are the results all of a sudden in the future going to be different? And I totally understand that. And that's a normal human being reaction. So the reason that I'm shooting this video is because this is what you will normally see on the internet, but this is what reality is. And yes, this is a nice way of depicting and providing data points and providing numbers to show you this result, but this looks a lot more challenging than something like this. So the question is, when we really look at the actual real numbers, which is always going to be the equity curve, right? And it feels like it doesn't actually line up with the actual strategy, which again is nobody's fault, but it is certainly something that is realistic. Again, this is an extreme example of what I'm talking about because it is a volatility expansion strategy, and we know volatility does not expand very often. How do we handle these types of things? right? How do we handle these types of things? And here's kind of the questions that I might ask myself if I find a strategy that has these type of results that just look really good, but then the finer details are maybe a little bit more challenging than the ultimate end result looks like. So I would ask myself a number of questions. Number one, should I, well, first of all, we should spell. We should spell correctly. Should I look at my results based on the daily, weekly, or monthly timeframes? Right? Something like this, if we take a look at those results, I may be more inclined to actually take a look at the monthly timeframes to be able to say, okay, once I kind of understand which of the timeframes I should probably look at, I should say, the sample size I am looking at, right? And maybe it's the last 1 to 2 months. Has that kind of result happened before in the study? Right? If you take a look at this equity curve, right? If you get all of a sudden to, you have 3 months of sideways, 2 months of sideways to lower, and then all of a sudden you get to this particular part where, hey, for 4 months, it basically goes sideways. Well, look, a couple months ago, the same thing happened over here. A couple months ago, it only happened half the time. Plus, maybe my win rate is exactly the way it was, just I didn't really get any of those massive volatility expanders, right? That would be a reason to go ahead and continue with it, right? Also, at the same time, what you really want to focus on is, am I doing the right thing on the micro level, knowing that the macro level will take care of itself? Right, this is really a major one. So again, this is what the macro looks like because this is the end of the 2-year study. We have a positive expected return per trade. We have a very nice profit or return to drawdown ratio. The average winner, much bigger than the average loser. That's what the macro looks like, but this is what the micro looks like. Right? So am I doing the right thing on the micro level, meaning following the rules of the strategy, knowing that because there is a mathematical edge here, clearly, because it's a significant mathematical edge on this particular trade, but knowing that there's a significant mathematical edge, am I doing what I need to be doing correctly on the micro level, which is, am I following the rules of the strategy? Knowing that the macro level will take care of itself, right? So these are some of the things you really want to focus on as a trader because, again, emotions are 90% of the battle. They're 90% of the battle. And when you see a macro result that looks like this, when you see a macro result that looks like this, but then this is what happens at the micro level, it certainly can be challenging. But we want to have kind of realistic expectations of, hey, what type of strategy is it? Is it a strategy that's supposed to have a very, very high win rate, your 80, 90% win rate, in which case maybe the overall results aren't nearly as good, but the frequency of winners and the win rate is a lot higher, right? What type of sample size am I taking a look at? Am I looking at the last 5 minutes? Or am I looking at the last month or so and then comparing that to other sample sizes that are similar size? But ultimately, the goal of a trader, regardless if you have a strategy that kind of looks like this or whatever strategy there is, the goal of the trader is this. Am I doing the right thing at the micro level? And the reason I say that is this. The macro level at least in my opinion, is inevitable. It's going to be very hard for a strategy that performs like this to all of a sudden just become absolutely horrible. Now, it certainly could happen, but it's going to take a brand new type of market, one that never experiences any volatility, to all of a sudden have this strategy become completely worthless and completely ineffective. So knowing that there is a mathematical edge here, because this makes $395 per contract, that's what lot means per trade, Am I doing the right things I should be doing on the micro level? Because if I have a strategy that has a mathematical edge and I'm doing the right things on the micro level, yes, there will be frustration from time to time because it can go months where there is sideways performance. But at the end of the day, in 2023, it's a 65% return, and then in 2024, it's a 59% return, right? In order to get those, you have to really focus on the micro, which is every day or every week, or this is a particular trade done at the same time in the same stock every single day. Same trade too. And by doing the right things on the micro level, because if I do the right things on the micro level, which is what I can control, the macro really should become inevitable, which is something I can't control. So really, I wanted to show this because, A, this is a really extreme example of a trade that has wonderful performance at the portfolio level and at the individual level. But the finer details may not be nearly as sunshine and rainbows as the actual macro result. And that is true for a lot of strategies, a lot of different systems when it comes to the market. But ultimately, if you have a strategy that has a big enough sample size of testing and you factor in things like real world commissions, real world slippage, if you factor in things like different types of markets, for example, and it comes out to something that looks like this, well, again, if you want to get a result like this, you have to grade yourself and you have to focus on the micro and understanding that when you have an edge, the macro eventually will take care of itself. Again, if you're a blackjack dealer, you do have a mathematical edge. After 10 hands of blackjack, there's no telling what the result is going to be between you and the gamblers. After 100 hands, there still is no telling on what's going to happen between you and the gamblers, but the odds favor greatly that you as the dealer will be more successful than the actual players or the gamblers at the table. And then after 1,000 hands, it is way more likely that the result of the outcome between you and the gamblers is that you've won, you've made money, and they have lost. So that's really the same thing when it comes to trading here. So again, it's pretty straightforward. Here's a strategy that at the macro level is very good. At the micro level, finer details may be a little bit more challenging. So when you are looking at the macro and wanting the results of the macro, yet are dealing with the micro every single day, your goal is one thing and one thing only. Am I following the rules of the strategy, knowing that the micro will be able to take care of itself? Again, that is how you stay in the game for a long time. That is how over months, quarters, half years, years, and decades, you continue to bring in money for yourself and be able to do whatever you want with that money. It's focusing on the micro. Now, if you like this video, go ahead and give me a like. Go ahead and click the subscribe button, smash the bell so you can be notified every other time I post new content. But really, this is one of the most important things you can ever learn when it comes to trading. Not every single day it's going to work in your favor. That's kind of the nature of the beast. If that wasn't true, everyone would be gazillionaires in the market. And I'll see you in the next video.